You're a little bit more cautious. Why?
I am. So three key reasons. Number one is our panic euphoria model, our primary sentiment metric, is sitting in euphoric territory. Not as bad as it was probably in March when we were seeing levels that were even above the bubble levels of 2000. But we are sitting with models suggesting 100% probability of losing some money. We're not talking about bear markets, 20% or things like that, but certainly 5–10% corrections seem very likely in an environment where your upside is much more limited. So the risk reward isn't necessarily skewed favorably. Number two, valuation pretty extended. You can make some arguments around interest rates being low and therefore you can support it, but that kind of throws out the whole idea of equity risk premiums, where I think a number of people are making a huge mistake. And number three, when you look at earnings revision momentum, it is slowing both forward guidance and percentage of upward estimate revisions on the street. So just to give you an idea, street consensus for earnings are $174 this year, and the market's probably pricing something like $190.
Tobias, hey, it's Alex in New York. I'm loving your photos, by the way. Well, where do you feel like the market is most complacent then?
So look, I think the market isn't necessarily complacent about the longer term. Many investors I talk to are worried about kind of what happens when the Fed tapers, what happens if we get more inflation data, which we think is very likely. What happens when we see tax increases, things like that. But in the meantime, as the markets are going up, I have to participate. I need to be involved. So we are suggesting that investors should be involved, but they should be involved a little bit more judiciously. So, for example, our work has been much more cautious on small caps now after being screamingly bullish for small caps for about 9 months. Another area we're very focused on is pricing power. What companies have pricing power to offset potentially inflationary pressures? And it's not just commodity prices going up. You're starting to hear this in the labor markets as well, even with 7.5 million more people unemployed than February of 2020, because in areas where they're tighter, like manufacturing, even certain services industries, you've heard about the rideshare companies not being able to find drivers, things like that, are starting to get tighter. And the NFIB is telling us the single largest problem for small business is quality of labor, which usually leads wage increases.
Tobias, given all of that, and what you said at the start, I got a VIX at 17. If I'm a sophisticated investor, do I buy protection at this point?
I would say yes, because we do think there's some risk. Again, we need to be a bit careful. We're not telling you this is, imminent doom or anything like that. Our bear market indicator checklist is not suggesting that either, but it is suggesting some pullback is likely as investors don't see everything as good news. The level of sentiment and level of bullishness is there. And we could see it through some of the work we do with surveys. We published our survey of clients for 38th or 39th quarter in a row, and it's showing that greater bullishness. Over 30% of our clients think that the market should trade well over 4,100 this year. And the average expectation on a weighted basis has moved up 200 points on the S&P from where it was in January.
Do you feel like investors are talking about tax increases yet, Tobias? Are you starting to factor that in also? Because that's like the next stool, kind of.
Well, it's one of the next stories that are going to come forward. I think we're expecting some sort of a budget proposal coming out in the next month or so that will begin to put the contours around it, but it'll be negotiated, and we probably won't see any kind of deal until maybe September. So from that perspective, I think markets want to have clarity on what is likely to happen. One of the big issues, for instance, is if there's going to be a kind of an alternative minimum tax for corporations. Well, what's going to happen to the GILTI tax, which is how a lot of technology companies have been able to move some of their intellectual property offshore to lower tax jurisdictions. Will that go from 10.5% to 21%? That would be pretty negative for a number of technology names. So some of this stuff is still to be worked on. And as long as investors don't have a pretty good idea of what that looks like, they're probably not going to price it yet.
Tobias, can we have a quick conversation about flows? I'm interested to get your take on what has been. Yeah, they are huge, but I'm wondering from where they are coming. Is the money that is going into them? So yeah, but is it cash? People, I just want to kind of reference the PPI print today. Is there money coming out of the bond market into equity? I'm just curious to get your take on this and how sustainable this all is, and which one's going to pick up and which one may fade.
So two things. One, the bond flows really haven't changed a whole lot. You'll get a week here and there, but generally speaking, people continue to put money into bond funds, looking for that stability. and net income. And certainly with bond yields moving higher, it gives them a little bit more comfort to make those investments. With regards to equity flows, I think it's mainly coming out of cash. And one other thing on bonds, just keep in mind that even if you had individual investors pulling out of bonds, you'd have the central banks pouring into bonds. So it isn't that disruptive. In the equity side, we're seeing it two places. One is retail investors putting money in, and they're not usually the earliest indicators for rallies. They tend to come a little bit later into rally mode. And the other thing we saw, particularly in the third and fourth quarter, data from the Federal Reserve Board showing that international investors had been coming into the U.S. buying equities, increasing their exposure to U.S. And that didn't, that made some sense, right? We were moving out of and reopening faster, vaccination, all that kind of stuff, stimulus programs. It meant for a stronger U.S. The dollar was something that people were looking at also. So investors internationally were coming in, and that's also not the early investors. They tend to be the tourists who come in a little bit later to check out the sites.
So the obvious question, Tobias, what do you want to own then? You have inflation moving higher, but the Fed most definitely on hold. You have reopening happening, but record highs in the S&P. So where do you get the beta and the safety?
So look, we think the value story and the rotation for value still makes sense. The cyclical conditions are going to be very strong. Again, a combination of the reopening as a result of vaccination and stimulus dollars coming in. The most COVID-impaired businesses are the ones that are going to be seeing some of the easiest comps over the next several months. And in that sense, their business trends are going to look pretty good on a relative basis. The financials will do better with a higher bond yield, which we think responds to potentially higher inflation. Now, just to give you one context on that, the business price index of the manufacturing PMI leads CPI, 10-year bond yields, 5 and 10-year tips break-evens by 3 months consistently. And all we've seen over the last several months is this rising trend on that business price index. So at least over the next 3 months, we're probably going to see some upward pressure continuing on some of this data that I think would be supportive of the financials, would be supportive of the cyclicals. And certainly as we reopen the leisure, hospitality, travel area, the place that you and I have been most deprived of in terms of activity because of the pandemic, is going to open up. I'll tell you, I was in Florida last week, and the activity is picking up when you talk to everybody in the service industry there. They've seen a significant change in the last, call it 5-6 weeks.